speaking of Big Blue, the company, at least on the credit side, is marketing more than $7 billion in dollar and euro bonds, kicking off what is expected to be a flood of borrowing from the tech sector in 2026. So we have assembled a Bloomberg roundtable from both sides of the pond to discuss all this issuance. We have reporter Ronan Martin from London, and here with us in New York is Robert Schiffman of Bloomberg Intelligence, who covers credit. And of course, let's start with Ronan. Tell me a little bit more about IBM kicking off this big tech bond sale, because it had just reported earnings, as Nora had told us, and we know that this tends to be a busy period for tech-related credit issuance.
Yeah, so it's interesting that we've kind of had a record year so far for bond issuance in Europe, and I think in the US as well. And this is even without the kind of big tech names that have been the fabled and kind of much talked about part of going into 2026. And then so IBM, like you said, was straight out of the gates this morning with its bond issuance in Europe after its earnings yesterday. It is priced a $3.5 billion deal, and investors were lapping this up. There's $17.7 billion of demand across the tranches. It's done really well. I think they'll be very happy with it, and it's part of kind of kicking off that big tech bond sale trend that we've been waiting for and looking for, and it's what's going to be coming in the next few weeks, I think.
Absolutely. So, Robert, let me bring this to you. This flood of issuance comes on top of a lot of issuance already tied to the build out of the AI infrastructure. We've seen all these big tech names sell a lot of debt, and it's been absorbed pretty easily so far. Spreads are really, really tight. But as more companies issue more debt, like an IBM that maybe was not anticipated, isn't that going to have, at some point, have an impact on credit spreads?
Yeah, last year was a historical high. And we did see a little bit of spread widening. Tech spreads had traded historically well inside of where the corporate index was. And we've backed up 10 or 15 basis points and now are trading pretty much on top of where corporates are. IBM's pretty much just the tip of the iceberg here. I think we're going to probably see more than $200 billion on an adjusted basis when we think about both public and private debt this year. But like Ronan said, extremely well absorbed. I mean, IBM's going to do a 30-year bond inside of 100 basis points. Demand for high-quality tech is voracious. And I think the constant news flow that we are in a bubble and that everybody is worried is much more of an equity story than it is a credit story.
So when you, Ronan, look at these companies that are getting ready to issue this debt and you look at what they're saying in earnings calls, how are you thinking about what credit investors are listening to and listening for to determine whether these are good issuances relative to what they might already have in their portfolio?
Yeah, so actually kind of in Europe especially, tech makes up a pretty small part of the index right now. Kind of European investors are quite underinvested perhaps in tech compared to a global scale. And I think for a lot of investors, these are going to be kind of exciting names that they're able to get their hands on. And part of the kind of appeal, so to speak, of the tech names is actually some of them are quite spread agnostic. They've got so much debt to raise, so much like money and capex that they need to spend, that they're going to be willing to pay a little bit more of a premium on the deals to get them over the line and to raise these kind of big sizes. I think IBM could just be, as you said, could be just the tip of the iceberg in terms of some of these deals. End of last year, Alphabet did some really, really large deals that were really well received with investors. And as far as we're all hearing, it's going to be more. And then on the investor side, they've got so much cash to spend. Cash just keeps rolling into fixed income for a variety of reasons, and there's so much cash to be put to work here.
So Rhoda makes a good point, which is investors in Europe are maybe under-owned in tech bonds, tech credit, because they don't have a lot of tech companies there, and maybe a lot of U.S. companies aren't issuing euro debt. But I wonder, in the U.S., all this tech debt coming through, are they going to be overexposed to tech as opposed to other sectors? I mean, doesn't that create a concentration risk?
Yeah, well, listen, this tsunami wave of tech issuance is going to spread overseas. We are going to see the biggest and best issue in euros, maybe in yen, in a variety of other currencies. So I think you're going to see that more to diversify their borrowing sources. But I think we have to remember, like, the type of names that are coming. You know, I've used the Mount Rushmore of credits. Like, these are the goats of credit. I mean, Microsoft is the goat AAA rated, there's a ton of room for people to put money into names like that. So regardless of how much spending is going up, and I think it's going higher. I mean, we originally thought last year that AI CapEx spending over the next 5 years was going to be $2 trillion. We raised that by the end of last year to $3 trillion. What we're seeing with names like Meta already, dramatically boosting what the CapEx spending is going to be this year. That number could end up being $4 billion. And a lot of that's going to be on the back of bondholders, but it's going to be within the companies that are rated AA and AAA that have more than enough room. And again, I think investors can't wait to wave in more bonds.
You mentioned AA or AAA. Those are investment grade ratings. Is there any chance that maybe their ratings might deteriorate a bit with this flood of issuance?
I think not. If you move down the credit curve, that's where some of the risk is. Names like BBB names like Oracle that are meaningfully negative free cash flow post their CapEx spending, or the CoreWeaves of the world that don't generate any free cash. But these type of names like the Microsofts, Metas, Googles, Amazons are sitting on 60, 80, $100 billion of cash, and they're generating like amounts of cash, even after spending 30, 40, 50, $80 billion in shareholder returns. They're still going to be free cash flow positive. So no, I don't really see those sort of concerns.
All right, the fundamentals speak for themselves then. All right, Robert Schiffman of Bloomberg Intelligence and Ronan Martin joining us from London. Thank you both so much for this credit roundtable.